At the register, a product can create a second sale. The customer buys a television, laptop, phone, or appliance. Then the screen offers protection for years after checkout. The product leaves the store today. The money for the protection plan begins a much longer journey. Some of it may become commission, some must wait for future repairs, some may never become profit at all. The offer sounds simple. Pay a known price now, and someone else may pay when the product fails later. But who is that someone? The store whose name appears on the receipt may not be the company legally obligated to repair anything. The company administering a claim may be different again. And an insurer may stand behind the provider without ever appearing in the sales pitch. The first distinction hides inside the name. People often say extended warranty, but federal consumer guidance separates a warranty that may automatically accompany a product from a service contract purchased for an additional price. The contract can extend time, add accidental damage, provide technical support, or cover failures outside the original warranty. It can also contain limits that matter more than the headline. That makes the central question larger than whether a repair occurs. What happens to the customer's payment between checkout and the end of coverage? To answer it, we need to follow the money through two retailers, one protection company, a model regulatory framework, and the contract terms that determine what the customer actually bought. Start with the cast. The seller puts the plan in front of the customer. An administrator processes enrollment, claims, service, and records. An obliger is the provider that carries the contractual promise. A reimbursement insurer may protect contract holders if the provider cannot perform. One company can fill several roles. In another program, the roles can be divided across a chain of familiar and unfamiliar names. Best Buy describes one version in its annual filing. The retailer says it sells hardware protection plans on behalf of third-party underwriters. Those underwriters assume the coverage risk and are primarily responsible for fulfillment. Best Buy is acting as an agent. That means the entire amount collected at checkout is not recorded as Best Buy revenue. Instead, Best Buy says its net commission is the amount charged to the customer minus the premium remitted to the underwriter. The retailer can also receive a profit-sharing payment tied to the financial performance of the underwriter's protection plan portfolio. The same filing says Best Buy does not share in portfolio losses. The retailer participates in defined upside without accepting that specific downside. For the fiscal year ending in January 2026, Best Buy said net commissions and profit sharing from extended warranties represented 0.9% of company revenue. That is meaningful inside a retailer of its size, but it is not a protection plan profit margin. It is a share of total Best Buy revenue produced by contracts whose individual prices, premiums, and economics remain private. Now compare Lowe's. Its annual filing describes a Lowe's branded protection plan for which the company is ultimately self-insured. Here, the retailer is not merely describing commission income from a third-party underwriter. It recognizes plan revenue over the life of the contract and records claim expenses when they occur. The same product category reaches the balance sheet through a different door. The timing matters. A customer may pay when the appliance is purchased, but Lowe's does not recognize all long-term protection plan revenue immediately. The company defers the payment and recognizes revenue on a straight-line basis across the contract term. For longer contracts, it also defers certain acquisition and administrative fulfillment costs. Cash can arrive today while accounting revenue and obligations unfold for years. At the end of January 2026, Lowe's reported $1.262 billion of deferred protection plan revenue. During that fiscal year, it recognized $580 million of previously deferred plan revenue into sales. It also recorded $239 million of claims expense. Those figures reveal the machine, but they do not reveal a simple profit margin. Subtracting claims from revenue would leave $341 million. Calling that profit would be wrong. The filing separately points to acquisition costs, administrative fulfillment, services performed under the plans, and the broader cost structure required to operate the program. Claims are the most visible promise. They are not the only expense required to make that promise credible. Allstate provides a clearer bridge. In its 2025 financial supplement, Allstate Protection Plans reported $2.3 billion of revenue. Claims and claims expense were $541 million. Amortization of deferred acquisition costs was $892 million. Other costs and expenses were $632 million. Adjusted net income was $179 million. This example changes the intuition. Claims were a major cost, but acquisition costs were larger, and other costs were larger too. The plan must be sold, distributed, administered, serviced, and supported before a repair is ever approved. The spread is not customer price minus replacement part, it is revenue minus a complete operating and risk system. Allstate's table is still one company example. It cannot establish an industry margin. Protection plans can cover phones, electronics, appliances, accidental damage, technical support, and different replacement obligations. Distribution contracts also vary. What the table proves is narrower and more useful. A low claims number alone cannot tell us whether a plan is highly profitable. Assurance shows the scale of the infrastructure. Its global lifestyle business includes mobile device protection, electronics and appliance service contracts, vehicle protection, and other products. For 2025, Assurant reported $1.64 billion of service contract revenue in that segment's fees and other income. The company describes work spanning program design, risk management, analytics, customer support, claims, repair, logistics, and device disposition. Those activities explain why the name on the store may not be the name carrying the obligation. Current Geek Squad terms generally identify Federal Warranty Service Corporation as the obliger and administrator, with named affiliates in Florida and Oklahoma. These entities operate under the Assurant name. Best Buy sells the relationship. The contract identifies who promises performance. Regulation tries to make that chain visible. The National Association of Insurance Commissioners created a model framework for service contracts. It distinguishes warranties from separately purchased contracts, defines providers and administrators, and offers different ways to back future obligations. A provider might use reimbursement insurance, maintain reserves and financial security, or meet a large net worth test. But a model act is not a universal law. States decide whether and how to adopt it, and product categories can be treated differently. The useful lesson is structural, not jurisdictional. Someone must remain financially capable of honoring promises that can last for years, even if the store has already recognized a commission or the customer has forgotten the paperwork. For the customer, value begins with overlap. If the manufacturer already covers a failure, the purchased plan may add little during that period, unless it offers a different benefit. Current Best Buy guidance says parts and coverage available under the manufacturer's warranty are not covered by the protection plan. Current Lowe's appliance materials also tell customers to consult the original warranty for coverage details. Then come the limits. A plan can include a service fee or deductible. Replacement may be new, refurbished, comparable, reimbursed as store value, or capped by the original purchase price. Accidental damage can be included for one product and excluded for another. A claim may require prior approval, proof of loss, maintenance records, an authorized repair network, or action within a deadline. None of that proves the contract is worthless. A predictable payment can be valuable to someone who cannot comfortably absorb a large repair, owns a failure-prone product, receives meaningful accidental damage coverage, or values fast service. The point is that peace of mind is not a single product. Its value depends on the price, added coverage, exclusions, claim process, provider and consumer circumstances. The same complexity can also hide disappointment. Federal consumer guidance warns that a contract may duplicate existing coverage, limit reimbursement, impose fees, or depend on an unfamiliar provider. The customer sees a simple promise at checkout. The actual product is the contract language and the financial capacity of the entity obligated to perform. Vehicle service contracts show what happens when the promise and the contract diverge. In 2024, CarShield and American Auto Shield agreed to pay nearly $10 million to settle Federal Trade Commission allegations of deceptive advertising. The agency alleged that many repairs were not covered as advertised, and that some consumers faced restrictions they did not expect. The settlement was not a verdict or an admission that every allegation was true. It also involved vehicle service contracts, not every electronics or appliance plan. In December 2025, the Federal Trade Commission announced more than $9.6 million in checks to 168,179 eligible consumers affected by the alleged practices. Cancellation and refunds create another pressure point. In selected auto finance examinations, The Consumer Financial Protection Bureau found servicers requiring onerous in-person cancellation steps, denying cancellations permitted by contract, and failing to provide accurate or timely refunds for unused add-on products after loans ended. Some consumers were paying for products they could no longer use. Those findings came from selected, anonymous auto finance examinations generally completed through August 2024. They are not an estimate of how often every protection plan fails. They show why unearned revenue matters. If future coverage is canceled or becomes unusable, the remaining amount may belong back with a customer rather than becoming a quiet margin. So how does the hidden business work? The customer pays to transfer a defined repair risk. In an agent model, the retailer may keep a net commission and possibly share in portfolio gains while an underwriter carries defined losses. In a self-insured model, the retailer can recognize revenue over time while funding claims and operations itself. Other programs divide the roles differently. The money that survives is not simply the amount left when nothing breaks. It is the spread remaining after commissions, acquisition, claims, administration, repair networks, customer support, fraud control, reserves, capital, and compliance. Some plans can produce attractive economics. Some portfolios can disappoint. Public filings show real businesses, not a universal formula. At checkout, the customer sees one extra line on a receipt. Behind it sits a contract, a risk pool, a distribution agreement, a service network, and years of obligations. The product is a bet on future failure. The hidden margin belongs to whoever can price that risk, sell the promise, honor the claims, and still have money left when the coverage ends.